Comparable Company Analysis from the Corporate Valuation and Financial Modeling course by Anish Patel. So, when you're asked to value a company, there's three primary ways of doing so, especially in the investment banking sense. There's the discounted cash flow analysis, the comparable company analysis, and the precedent transactions analysis. The comparable company analysis is what we're going to look at today. So, when you're doing a comparable company analysis, there's four primary steps: determining the peer group, determining the multiples to measure, collecting the data, and finally spreading the comps. So when you're determining your peer group, or the peers that you're going to value your company based off of, you look at qualitative measures first, such as products, the similarity in products, the suppliers and consumers, and finally geography. In terms of quantitative measures, you compare the size of the companies and the performance of the companies. And the sources for this data are going to be the 10Ks of the company you're looking at and equity research and any sort of news. For step 2, determining which multiples to measure, you have to look at the fact that there's three types of multiples. And the way you create them is by looking at the measure of a company's value versus the measure of the company's performance. The first type of multiple is the enterprise value multiple. Now, these look at the company's value in terms of enterprise value over the measure of the company's performance in terms of which indicators represent the full capital structure of the firm. Some examples of this are EV to EBITDA, EV to EBIT, and finally EV to sales. The second type of multiple we can look at is the equity value multiples. These look at a company's value in terms of equity value, so essentially market cap, over the measure of a company's performance, which relates strictly to only equity in the capital structure. Some examples of this are price to earnings and price to book. The third type of multiple you can look at is industry-specific multiples. These will be relatively unique to various different specific industries, and they'll be more determined not necessarily on the company's value, but determining what type of performance metrics they can look at that are very important to that specific industry, such as for oil and gas, you look at total reserves to annual production. For retail, you look at sales over total square footage. And for airline, you look at passenger revenue over available seat miles. The third step in the comps analysis is collecting the data. So you can look at historical data, current data, or forward-looking. But we typically look at forward-looking for comps analysis, or most types of valuation methodologies. And the sources for this are going to be the company's 10Ks and 10Qs, Bloomberg, CapIQ, FactSet, any type of business information database, and finally equity research reports and forecasts. Now, this is the most important step. This is actually spreading the comps and essentially coming up with the value of the company you're trying to target. So we're going to quickly switch to Excel to look at this. So you'll notice over here we have the company and the ticker, pretty important indicators for a public company comps. And then over here we have the calculations for market cap. We have the value for enterprise value, EBITDA, and net income. So we're going to look at one equity value multiple and one enterprise value multiple. The important things to consider are typically to find enterprise value, you'll take market cap, add any debt outstanding, subtract out any cash and equivalents. Now these will include not only just cash but also marketable securities and any short-term investments or highly liquid investments. And you're going to add back any minority interest. So this is typically another calculation rather than being in blue, which means it's an input cell. EBITDA and net income you can get straight from 10Ks. However, you want to scrub them for any type of discrepancies and types of ways that these different companies are measuring their metrics. And then finally, this is probably the most important part, is actually coming up with a multiple. So if you notice the price to earnings ratio, that's going market cap over net income. And that's the same all the way down for each of the peers. And for enterprise value to EBITDA, similarly, you're going to take enterprise value divided by EBITDA. But as I said before, enterprise value is typically going to be a calculated value. And then for each of these metrics, you're going to look at it in terms of a range. So min to max, and you'll also look at a mean. Typically, these types of calculations, such as for market cap, for enterprise value, or any types of these numbers that are going into the price to earnings ratio or into the EV to EBITDA ratio, won't actually be shown in your the main portion or the output of your comps. So let's go ahead and shrink these sides so you can see what typically would be shown on an output. So on an output, you'd typically be able to see the ratios, and that'll be probably 8 or 9, maybe 10, depending on what kinds of things you want to look at. And you'll have the stock price, ticker, company name, and the market cap in terms of those inputs that might actually go into the ratios. And then you would show your range, or a lot of times you'll have median and mean, and the min and max might be shrunk and will come into play when you're actually determining the value of the company. And then your calculation for the target company is also typically not shown in the output for comps. For a comps output, you typically only see, this portion right here. And like I said, it would most likely be the median and the mean rather than all four of those measures. Now let's look at how you actually get an implied share price using the price to earnings or EV to EBITDA multiples. So if you look at this formula for price to earnings, you'll notice that it's the net income of the company that you're looking at, or the target company that you're trying to value, multiplied by the minimum price to earnings ratio. And that's because, like we looked at before, price to earnings is essentially market cap over net income. So if you have the minimum of the range of all of your peers and you multiply by your personal net income, you'll get an implied price or market cap. And so if you notice, the first portion of the formula is the minimum price to earnings ratio multiplied by the net income of the target company, and then we're dividing by the fully diluted shares outstanding. And you'll notice that that's also hidden here, the fully diluted shares outstanding. And the reason we're looking at fully diluted versus shares outstanding in general is because the dilutive effect of employee stock options or treasuries and warrants are very important, because when I go to value my company, I want to know what the exact potential of all shares outstanding could be. And that's why we're going to look at fully diluted versus just the shares outstanding right now. So that's why we divide by the diluted shares outstanding. And similarly for the max on the range of the implied share price, we're taking the maximum of the range from all of your peers, multiplying it by the net income of the target company, and dividing by its fully diluted shares. So that's going to give you a range on the share price, determined using the price to earnings ratio. Now if we look at EV to EBITDA, you'll notice that it's a much more complicated formula, and that's because we have to back out from enterprise value down to an equity value and then divide by fully diluted shares again. So you'll notice we're taking the EV to EBITDA multiple, that's the minimum of your peer group, and then you're multiplying that by your target company's EBITDA multiple. So that should give you an enterprise value. And then from that, we're subtracting the total debt minus cash and equivalents, and that's because you want to subtract by net debt of your target company to get to a potential implied equity price, which you then divide by the fully diluted shares outstanding again. Similarly here, you'll notice that it's the max of the range of your peer group. Instead of doing a min to max range, you could do a fourth quartile to third quartile range. It's really very highly subjective in terms of how you're going to determine that range. So let's switch back to the course really quickly. So I just want to note that scrubbing the inputs is one of the more time-consuming steps, because all the metrics need to be apples to apples, like I was saying. If peer group 1's EBITDA multiple or EBITDA is measured differently than peer number 4's EBITDA, you have to obviously spend some time making that adjustment. So let's just go through the comparable companies analysis again. First, you're going to determine your peer group, then you're going to determine the multiples to measure, collect the data, and finally spread the comps and get your target valuation. So the implied valuation, like we went over in the Excel, is going to be you take the price to earnings multiple and multiply by the target EPS for your company. And that will give you the implied share price, and that's how it's going to work for any equity value. Some issues with doing a comps analysis are it's very difficult to find true peers. How many peers are going to be selling the exact same products, have very similar sizes, and be in similar geographies? It's a very difficult thing to find companies that are that similar. Second, market conditions and sentiment can swing your company's valuation, because if you remember, especially for an equity value multiple or even an EV to EBITDA multiple, you're adding in market cap, and market cap is going to be determined very much so by market conditions and sentiment, because you're looking at only public companies when you're doing this. And finally, the range is highly subjective. Like I said, you can be looking at a range of min to max, or you can be doing first to third quartile, or you could squish it down a little more or spread it out more. It's going to be completely up to you what you show in your output or when you determine your implied valuation. So that was just the overview of the comps. And finally, the corporate valuation and financial modeling. Of course, we just went over the comps analysis, and check out the discounted cash flow and precedent transactions.